Kia ora and welcome to episode 31 of Bridge Talks Business with Milford. This week we get to hear how American companies are performing. Why do we care about Apple, Nvidia and Walmart, I hear you asking? Well, the health of the world's largest economy gives us an insight into the health of everybody else's. Bit like the Amazon rainforest for climate change. First up, here's your top 5 business bits. Number 1, shares have regained most of their Liberation Day losses. Talk of deals over escalation is music to the ears of investors, but given negotiations for trade take time, the risk might now be that optimistic investors are left wanting when it comes to concrete evidence of deals done. Number 2, the US economic data out in the last week's been pretty strong. Quarter 1 GDP solid, labour market reports showed good job growth. The question though, is this a resilient economy or is this a pull forward of demand pre-Liberation Day? Number 3, uncertainty and pessimism were the themes coming out of the business and consumer surveys. These are feelings though. We await hard data. Number 4, little reaction from shares, bonds and currencies to Albo expanding his majority across the Tasman. Re-electing the incumbent means continuity in economic policy. Number 5, the Fed will likely hold rates steady this week given elevated inflation and no evidence of actual weakness in the labour market in the US at this point. The Bank of England, they look set to cut, and in New Zealand we get quarter 1 employment data. All right, it is interview time and we've got a lot to get through today, so we'll just crack straight on into it. We're joined by Francis Sweetman, Milford's Portfolio Manager and Head of Sustainable Investment. Just to note that this segment is informational only and should not be considered financial advice. Francis, welcome back to the podcast.
Thank you.
I was beginning to think you were avoiding me. It's great to see you. And we have it's sort of a good news story, what's happening with the stock market, that it's basically, in large part, recovered from Liberation Day already. People are kind of hopeful for what they're hearing coming out of the White House.
Yeah, that's right. I mean, we just had this incredible month in April where we had the big tariff announcement on the 2nd and a big sell-off in financial markets, a lot of bumpiness in the middle, and then this real recovery towards the back end. And we're now seeing markets at similar levels to before tariffs were announced, which is unbelievable. In fact, Morgan Stanley said it was the 5th most volatile month in 85 years. So it really is an incredibly unusual time with all the changes in tariff rhetoric from much worse than expected to some easing back. You've got these Department of Government efficiency announcements there was a huge flurry of out of Elon Musk, and then they've really quietened down. And we're also seeing some relatively resilient US economic data, and people are very concerned about what's going on in the underlying economy given the risks that we're facing. So it's an incredible environment.
A lot of, as you say, a lot of very loud rhetoric coming out of the White House. It's huge swings in reaction from the markets. But there are some complexities to this, and we'll talk about that. So we've had quarter 1 reporting season sort of starting, and we're seeing some results. As you said, there's some solid stuff coming out, but a lot of this was before Liberation Day, right? So, but what are we seeing from these quarter 1 results?
And they've been a real focus as investors try and understand what's going on in that underlying economy, as I say. And actually, the first quarter appeared to be relatively resilient. The results have been pretty solid and have indicated that there isn't that broad-based weakness starting to come through, or at least there wasn't in the first 3 months of the year. And then when you match that with that slightly more resilient economic data, I think that's been a real source of relief for investors.
So what does that tell us? I mean, we've got what about the forward track, when the companies look forward and hopefully give us an idea of what they think will happen given the tariff environment?
Yes, and that is always the focus, is that outlook. And this time, as you say, more than ever, we've got this 3-month reprieve before those tariffs actually come in, and we've had this big drop in consumer and business confidence and those more forward-looking indicators. So investors were laser focused on company outlooks and any guidance that they're prepared to give. And that was more difficult. It's very, very difficult for companies to give an outlook in what is this incredibly uncertain environment, particularly when you can't tell if there's been a bit of pull forward in demand that was helping those resilient first quarter results and how particularly consumers are going to respond. So outlook statements were definitely more cautious.
This is the idea that perhaps everybody was getting ahead of the tariffs ordering in, getting all of their raw materials and whatnot ahead of time. So it's artificially inflated those Q1 numbers.
Exactly. And there were some signs that was happening, but not consistent or broad-based enough to make that a very strong indicator. And then we also had really poor weather in the US at the very start of the month. So there may have been some shifts in demand in the second half of the quarter because of that. So not clear, but yes, some signs. And so that has made, those outlook statements even more important than ever.
All right. Let's talk about some of these companies that are reporting. Let's start with some big tech companies. What have we heard so far?
Big tech was actually a source of real relief and was quite good. The likes of Google, Meta, Microsoft all reported that demand was actually really solid for software, storage, advertising. Businesses are still spending, and they're actually quite confident in the outlook. They've got big pipelines, and all of that demand appears to be really robust. So that's a great signal, because there's been two concerns really sitting on that sector. The first is some of the efficiency gains that the likes of DeepSeek AI models have seen that suggest that we actually don't need to spend quite so much on tech as we thought that we did. And then on the other side, US businesses could shut down investment in IT spending quite quickly in a very uncertain environment. But it doesn't appear like either of those are translating into drops in demand at the moment. So it was a great result season for those big tech companies.
And what are they predicting about the future?
Well, they only give us outlooks maybe 6 to 9 months ahead, depending on where they're sat in their financial year. And at the moment, they're saying they've got really robust pipelines of demand across a broad range of customers, all their buckets of customers, in fact. So from what they see, IT spend is so incredibly important to the success of businesses and the development and growth in, AI models and new ways of working, that is going to stay really resilient. So that's the message from those companies.
We've spoken about this before, Francis, but the strength of the US consumer. I mean, through last year, the strength of the US consumer was something to behold.
Yes.
It was like the Energizer bunny that just kept on going and going and going and going. What are we seeing from some of those consumer-facing businesses about that consumer in the US?
Yeah, and I think the consumer space was one of the main areas where that weakness in those outlook statements we were just talking about really came through. Again, the first quarter was pretty resilient. The likes of Visa, MasterCard, Amazon said spending held up okay. But consumers are definitely very cautious in the US. They're spending less on restaurants and food. The anticipation is that tariffs will raise prices, and that will see consumers keep their hands in their pockets. So we saw downgraded expectations across a wide range of food retailers, packaging companies, even leisure spend, things like airlines and hotels. Both Wyndham and Hilton downgraded their outlooks.
Macca's was down too a bit, wasn't it?
That's a great example, because it's such a bellwether for the US economy. And they saw US sales down about 3.5%. But foot traffic across that really important, more low-income consumer that's more sensitive to some of these changes was down double-digit. So that's a real signal that the consumer's hurting and is very, very, very cautious.
So a very mixed picture and a lot of uncertainty looking forward, as you say. What about the UK and Europe? Because this was seen as almost the panacea. It was seen as the tonic to what was going on in the United States has been. Companies there living up to expectations?
Actually, they are. I'll give you a few examples. Banks is quite a big economy in Europe and the UK. Quite a big part of the economy in Europe and the UK. Quite a big part of the share market, and also again just a really broad-based exposure to understand what the consumer and businesses are doing. They all reported good results. They're not seeing any signs of weakness or stress across any of their customer buckets, so that was helpful. Again, packaging companies, they reported better sales in Europe than the US. And even really tough industries like UK supermarkets said UK consumers are responding really well to promotions, additional advertisement. And that's a very different picture to the US, where perhaps cheap deals are seeing consumers switch to spend less, but not necessarily buy more. Whereas in the UK, consumers are still buying more when they see really good value, great offers. So it just flagged the difference between what's going on in Europe and the UK and what's going on in the US, which is great. So I think it really helped to reassure investors that it's still a safe place to hide.
Yeah, so that's a good way to put it, a safe place to hide. I want to talk about that in a second. But how are the markets reacting to those results in Europe and the UK?
I mean, those share markets continue to be strong. It's really difficult to unpick why, but I think those results would have definitely helped.
Is there a risk, because everybody talks about it, I mean, you said it's sort of where everyone likes to run to for safety. Is there a risk with everybody doing that to the UK and Europe that, if something goes wrong there, I mean, do you need to be prepared for unexpected things everywhere?
It's such a great point, because one of the things that can really catch you out in share market investing is complacency and not expecting the unexpected. And it has become a real safe haven, and you have seen investment or money flow out of US share markets and into European and UK share markets because of that real shift in outlook. And if maybe we get, say, a real U-turn in tariffs, and suddenly the US puts huge tariffs on EU.
Trump does a China on the EU.
Exactly, not what we expect, but expect the unexpected. Then, given that everyone is hiding over there, or there has been this shift of flow in investments to the EU and the UK, then that would be, a material negative for those markets. So it's a good reminder not to be complacent.
Right, looking ahead, who haven't we heard from yet, and what are you expecting?
So we're about 75% of the way through now. But I think the area of the economy that we haven't heard from, particularly in the US, is some of those sort of manufacturing businesses, that kind of business investment part of the economy, industrial companies, more sort of broad-based industrial companies. And that will be really interesting because business confidence has dropped the same as consumer confidence. And so this could be another real area of weakness where businesses are not willing to invest or not willing to spend ahead of what could be material changes in their market and cost base. So we're expecting a bit of caution there. And then the other one that hasn't yet reported is, of course, NVIDIA. That's not till right at the end of the month. And that's always a real signal of broad-based market feel or market confidence, the response to that result.
Vibes.
Yes, yeah, that's right. But I mean, a lot can happen between now and the end of May. So, I think it's almost sort of not today's problem yet.
Frances, thank you so much for coming back on the podcast. Don't leave it too long till we see you again.
Thanks, Ryan.
Lovely to see you.
You too.
I'm sure we'll see Frances again soon. That's Frances Sweetman, Milford's Head of Sustainable Investment and a Portfolio Manager. That's it for this week. We'll look forward to next week's instalment of the Bridge Talks Business Podcast with Milford. Don't forget you can like, follow and subscribe wherever you listen to your podcasts. See you then.